You are listening to Keystone's Stock Talk Show, episode 234. If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook. And keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold. Once again, we have a busy show planned for you this week on the heels of our final DIY stock investing webinar of 2023, which are still available on demand. We answer 4 Your Stock Our Takes. Aaron begins by going back to back on restaurant investments, answering a question on A&W Royalty Income Fund, AW.UN on the TSX, the famous root beer selling quick service burger joint, which sports a 6% plus yield. The yield is strong, and Aaron looks into whether the company has any room for growth going forward. I will be answering a listener question on a stock which should be no stranger to our clients, having been a long-term buy for well over a decade in our Canadian small cap growth stock research. Boyd Group Services Inc., symbol BYD on the TSX. Boyd is one of North America's largest operators of non-franchised collision repair centers, with approximately 130 locations in Canada and over 724 sites in the US, for a total of over 850 centers all told. This stock reported solid Q3 results, and a listener asks if we're still positive on a name that is now close to $250, and we recommended it originally at $250 or under $250. Brett answers a viewer question on Pivotree Inc., symbol PVT on the TSX Venture, an end-to-end provider of e-commerce supply chain and master data management services to over 180 large and mid-market retailers, branded manufacturers, wholesalers, and distributors in North America. The stock is down 45% year to date, and a viewer wants to know if we saw any improvement in the just reported Q3 numbers. Finally, in our Your Stock Our Take segment, Brennan answers a question on Pollard Banknote Ltd, symbol PBL on the TSX, which serves the lottery, instant ticket, and charitable gaming markets primarily in North America. The stock is up 66% this year, following a significant drop from mid-2021. Is the recovery sustainable? Brennan will let you know. All right, let's get to the show. And welcome my co-host, Mr. Aaron Dunn, and the Killer Bees, Brett and Brennan. How are you guys doing? Have a good weekend?
You betcha.
I did indeed.
Yeah, the Oilers got their first dub under the new coach, so that was nice to see.
That's
and,
monumental.
Vancouver continues to be on an absolute tear.
Celebration for you out there.
The Canucks apparently to the kids out there, they're a wagon. That's what
I've been telling you.
You've been calling them, right?
Yeah.
Yeah, no, again, it's a small sample size. It's funny. I had a chat with a client today, and he said, and I said to him, it's still a small sample size, but it certainly is more fun watching them win a few games than getting
Actually, I think I might
for
go
11
see a
years.
Game. So,
nice.
Well, that game they're sure to lose. Let's be honest.
Yeah, well, that's the thing is if I start getting
don't go,
then that's going to be
don't
the
go
end of any streak.
Don't
so
go.
Maybe I should just stay away.
It's true. It's been good. Although you weren't there during a lot of the losing anyways. You got out of there quickly, right? Smart. It's like a stock that's going down. Aaron gets out quickly. He's gone. The 11 years we sat there and waited on this company. Although I complained all the way. So
you did, yeah.
It's true. Just on a final note, our live DIY webinars from the past 2 weeks, they are available on demand. If you go to the website, you can still grab those now. Those are our last of the year. So we happy to have those completed in the bag. And now you can watch any of them there. There's 7 stock recommendations within those. Mm-hmm. Okay, well, we want to get right to it. Like I said, busy show. We've got 4 Your Stock Our Takes. Aaron's going to go, you're back-to-back here. Last week it was QSR, right? And this
That's
week
right,
you are going with A&W.
For that McDonald's.
And oh my God, it's back-to-back-to-back.
I know. I'm actually not doing this intentionally. 3 restaurants in a row. I
You just
realized as
cover
I
the
was
quick service
doing the
industry.
slides for
Yeah.
A&W that I'm 3 consecutive weeks on restaurants, all fast food, by the way, quick service. So it's not intentional. It's just happening. So
It's strange, but suddenly you got a hankering for all of those brands right after doing it, and you're out, dining on McDonald's,
maybe the hankering came
Popeyes.
before, right? Like, and
Yeah,
that's why that's just leading me to the stock. No,
probably.
in the case of A&W, we do a weekly Q&A for our clients, and the client
We
actually
get
asked
questions
about it.
on it. Yeah. Yeah.
Yeah, so I figured, this is a company we actually covered as a buy recommendation many years ago. This is when the yield was much higher than it is right now, but we've been following it since then quite closely. So I figured, why not just take a look, because they had just put out their Q3 results, kind of get a sense of what the growth outlook is like going forward, and if there's an opportunity, and then talk about it on the show. So I'm ready to go here if you guys are ready to listen.
Go.
You bet.
All right, excellent.
I
So
don't know if we're ready to
company,
listen, but go.
just turn off your volume and
Yeah.
go to sleep, take a nap. Okay, so the company we're going to talk about is A&W Revenue Royalties Income Fund, AW.UN. Trades at $31. It's a 500 million market cap company, and it pays a very nice yield of 6.2%. So this is actually a somewhat unique company in the Canadian market. They are a trust, and they were established to invest in A&W trademarks. So what they do, as per their name, Revenue Royalties, is they get a 3% royalty on the revenues of all A&W restaurants in the royalty pool, which right now is 1,037 restaurants as of the end of the third quarter that was just reported. So A&W, this is the second largest burger chain in Canada. They have locations all over the country. Very strong brand. Of course, everybody knows A&W. It's right up there with the big brands like McDonald's. And it's a very interesting situation that A&W has in terms of the way they make money. So, or A&W royalty revenue. So this is not actually A&W. They don't own the restaurants. A&W Revenue Royalties, AW.UN, which we're talking about, just owns rights to the brand, that 3% royalty on revenues. Now, when we look at the long-term chart of this company, it's done fairly well over time. We can trace its performance back to 2006. Very big drop during the pandemic, and this is because most of the restaurants essentially shut down for a time being. They had a pretty good recovery, but just recently, over the last 18 months or so, they pulled back. So year performance, it's fairly flat for the year. A lot of volatility, but down since April. So we want to take a look at the company. They just put out their Q3 results. Take a look at what the opportunity is going forward. So same store sales growth in the third quarter was 1.1%. That was down from 4% in the third quarter of last year. Now, the same store sales growth in 2022 was much higher because there's a lot of recovery from the pandemic where there is a big drop. But, this is a company that has generated fairly consistent same store sales throughout the period where we've been following them. A number of restaurants in the royalty pool, that increased by a net number of 22 restaurants, so up 2.2% year over year, a 3.8% increase in royalty income, and 2% increase in distributable cash flow per unit. So this is really the metric that we look at mostly, distributable cash flow per unit. The purpose of AW.UN is really to pay an income distribution to its unit holders, its investors, and then to grow that distribution over time. And payout ratio, 81% for the quarter. Pretty good payout ratio for a company like this. Really, though, I would look at the 9 months as a better gauge of how the company is performing. So same store sales growth 3% for the 9-month period, royalty income up 5%, distributable cash flow per unit up 9%, and then the payout ratio of just under 93%. And this is really likely where we're going to see the payout ratio. Now we're going to see it, generally in that mid 90 percentile range. Sometimes it can drop lower in a particular quarter, but this is a company that really the purpose is to distribute nearly all of its income out to its investors. So normally when we're talking about a business where there's a lot of capital that they want to reinvest, we'd be looking at payout ratios in the 60 to 80%. as being more reasonable. But for a royalty streaming company, you're generally going to see that 85, 90, 95% payout ratio range. And that's okay, because that is the purpose of the entity. Now, one of the main sources of growth for this company is same store sales. And in that regard, A&W has done a very good job over time. Fairly consistent, positive same store sales growth over a long term time horizon. This chart here dates back to 1917, but we could even go before that. Now, a lot of that comes down to them being very innovative with their menu. So it was a big boost to them when they added the Beyond Meat burgers in 2018, and this was when that was all the rage back then, right? But they make other modifications to their menu on a regular basis, really trying to essentially acknowledge current trends. And this is part of the reason why same store sales growth has been strong. Now, in some periods, it gets upwards around 10%, even to the teens. That's not sustainable. In 2021, we can see here 14% same store sales. That was really recovery from the 14% drop that they experienced in 2020. A number of restaurants as well is another way that they generate growth. So just increasing the restaurants in the royalty pool. And we can see over time, there's just a gradual increase in the number of restaurants. So currently 1,037, up from 1,015 in 2022, 994. So just every year they're adding to that royalty pool. And then tracking back the annual distributions and payout ratio. So, really, this is a company that you're investing in for yield. Can almost be seen as a yield co, although they are expanding the size of their pool. And as I said, that the same store sales growth also adds. But you want to it's really there to maximize that income distribution, and the income yield right now is just over 6%. So generally pretty consistent growth over time. We can see the payout ratio over the last 10 years or so has been close to that 95% range, which is where we would expect it. And they're growing their distributable cash flow per unit, at least over the past 10 years, at about a rate of 3% per year. So reasonably speaking, I think that the 3 to 5% is really what we should expect from the company. I wouldn't necessarily look at this as a company that can maintain growth beyond that level, at least for any sustained period. And right now, based on distributable cash flow of about 194 per unit for the trailing 12 months, it's trading at about 16 times, which we consider to be a reasonable valuation. So our take on A&W, we do really like that revenue royalty structure. It's attractive. And when I say it's attractive, what I mean is that it's a very clean structure. So they don't have to worry about the operating expenses of the business, or a lot of the inflation that impacts those expenses, like wage inflation, inflation on equipment. They're getting a royalty right off of the top line, and there's really no cleaner a structure than that. There's not really a lot to the business in terms of analyzing the balance sheet. Very little debt in their capital structure. They really just exist to get that royalty off of A&W and to provide an income yield to their investors. So it's very clean structure. We do see consistent growth. That's in the number of stores, consistent growth in cash flow, consistent growth every year in the income distribution. And of course, it's a well-recognized brand. One of the reasons, and I've said this in the last couple of weeks, that I like the quick service restaurants or the fast food restaurants is that they generally have a reputation for being more recession resistant. You're getting a lot of more bang for your buck from these quick service restaurants in terms of calories per dollar spent. So they're not as volatile generally as the mid-range restaurants, the sit-down restaurants. And then, of course, reasonable valuation, attractive yield. They have all of that. So there's a lot of things that I like about the company that could make it a good investment. Now, on the negative side, although there's consistent growth, it's really pretty moderate. So we're looking at that single-digit percentage growth over time, in terms of what you're going to get from a rising income distribution. Q3 results, they did look a little bit weaker, not necessarily a big deal, but something to monitor. Same store sales 1.1%. That's lower certainly than what we would expect over time. They do have an attractive dividend yield, but it is really competing right now, at least in the near term, with bond yields. Being that it is a relatively slow growth business, we're seeing a valuation that's lower than what we've seen for most of the last 10 years. Because 6% 3 years ago was incredibly attractive. Now, when you can get 5% plus from a GIC, it looks less attractive. Now, of course, the difference is that when you reinvest your capital from a bond when it matures, or a GIC when it matures, you don't know what your rate is going to be. And in fact, there's a very good chance 5 years from now it's going to be much lower than you're getting currently. Whereas with a dividend grower like A&W, you should actually get a growing income distribution over that period of time. So that in the long term differentiates it significantly, but in the near term, this is what investors are looking at. Now, that could be a long-term opportunity, because as interest rates drop, the company starts to look a lot more attractive, and that valuation increases, which would be good for long-term investors. But in the near term, this is part of the reason why it's been struggling in the market. So our take, we do think it is a solid long-term income producer. It's not what we would consider a growth stock, but for investors that are looking to own it for the long term, we think that taking a position in it would not be unreasonable. It's not currently a recommendation of ours right now. Partly that is due to the lack of growth, but I mean, I would say that it's close. I mean, it's certainly something I wouldn't argue with a person if they wanted to take a small position in the stock, just to be invested in a strong brand with a solid yield and a growing distribution.
And most importantly, it remains one of my favorite of the quick serve restaurants in terms of actually dining at. So that is an important factor.
Well, that is an important factor. Yes.
Of the three companies you recommended, and a couple of them have several brands, I believe, which is your favorite to eat at? That's a critical question here. First, Aaron. It's a
I'm going to be honest with you, McDonald's. I don't eat much fast food. Yeah, but I would probably go to McDonald's over any of the others. Yep.
Brennan?
Probably A&W, and like just like an insider tip, get their fries extra crispy. Ask for them like extra crispy. Okay. I find that they're so much better. One of my friends gave me a tip on that. Now you're up, Brett. Your fave?
Unfortunately, I agree with Brennan. I like A&W.
Oh, 3 against 1, Aaron.
I just feel like
What's your second favorite?
Investment, I would probably pick A&W over the other three.
Okay, good. Well, that's because we're literally funding your investment
too. But generally speaking, it's very rare that I get fast food. Maybe it's just because McDonald's are more accessible. But it's been a while since I've had A&W. I've had McDonald's.
I'll tell you, the kids still, the marketing, they still love the Happy Meal. They still love, the
well, it's
toy
an
and
impulse
all
buy too, right? Like it's usually like the time that I would get it. Like in terms of fast food, really, my family is a Wendy's family. If we're gonna get fast food and there's a Wendy's,
I like Wendy's too.
That's our restaurant of choice. But if we would eat at McDonald's, it's usually because we're coming home from some event or like out to see family or something.
And there's one every 5 feet.
Some food, and there's a McDonald's right there. So
yeah.
One thing that I'd like to say too on A&W's marketing, like this is like a test that, because I didn't know that they were started in California. I thought from a young age that they were always a Canadian company.
Almost everybody thinks they're Canadian. It is
which is like they've done so well marketing where like go to somebody and ask them where do you think A&W started, and a lot of people will say in Canada, even my dad asked, or I asked that to my dad, and he was shocked, when I told him that it started in California. So, just what a great marketing strategy as well. Or they've done
become
so
part
well.
of Canadiana, kind of.
Mm-hmm.
Are there still A&Ws in California?
Oh, I would assume so, but I don't know.
But that is where the roots are for sure.
Yeah.
And most would just associate it with Canada completely. Yeah. All right, let's move on to another company that started in Canada. Well, this actually not another, because A&W didn't, but a company that actually started and has its roots in Winnipeg, where the base of this business is. It's the Boyd Group Services Inc., symbol BYD on the TSX, $246. That's where it trades at, $5.2 billion market cap. The company is one of North America's largest operators of non-franchise collision repair centers. The company operates about 130 locations in Canada, under the trade names Boyd Auto Body and Glass and Assure Automotive, as well as 724 plus sites in the US under the Gerber Collision and Glass brand names. That's about 850 centers in North America. They just released their Q3 results. Revenues were up 17.9% to $737.8 million. Same location growth was about 11.8%. Adjusted EBITDA was up 28.7% to $94 million. And adjusted net earnings came in at about $1 per share, up from 56 cents. So good jump there. And net earnings came in at around 95 cents, up from 55 cents in the same period last year. Now they're lapping some lower numbers, but still good growth there. In terms of valuations, forward-looking EV to EBITDA based on this year's expected numbers, they're three quarters into the year is about 14.7, which is slightly below the 10-year average. We see it as fair value in the near term. Let's look at some quarterly notes. Now, coming out of a challenging pandemic, Boyd has continued to have success capturing price increases from insurance partners alongside better parts margins. And we're seeing that now. While the acute labor challenges, the company has had very significant labor challenges coming out of the pandemic. These are now fading. Labor scarcity does remain a challenge, and Boyd continues to work with insurers to secure progressively higher pricing so as to ensure that there is sufficient available labor and operating capacity in the business. On the M&A front, Boyd added 21 locations in the quarter, consisting of 4 greenfield and 17 acquired shops, including 3 small shops, one small multi-service location that had 3 shops. That's what I'm trying to say. Boyd's strong earnings momentum this year has supported a return to more active M&A, and with an initial focus really on just single shops. They had commented, management commented in its quarterly comment call that they suggested the firm is beginning and becoming more open to larger deals once again, as we've seen in the past. So that is something we can look forward to over the next year. Same location growth. After 7 quarters of double-digit same location growth coming out of the pandemic, Boyd has been tackling those labor and supply challenges, and it sought to improve capacity. Management kind of suggested going forward that it sees some moderate deceleration through the year end, although we're still looking at a healthy same location growth in between 6 and 12% going forward into next year. Overall, Boyd is a quality capital compounder. Now we're going to update our clients fully on this company, if I can speak, this week. All right, that ends it. Any comments on Boyd?
I actually just had a call with a client who was a shareholder of Boyd as well. So it's obviously a company that we never get tired talking about. But
yeah,
one of the things that he had mentioned is that he did take some profits about 1.5 years ago, and he referenced the price to earnings ratio. He thought that it was getting a little bit expensive, and just wanted my feedback on it. And I think he was looking at nominal earnings, and I talked a little bit about price to cash flow, price to adjusted earnings. But I mean, it's not been a cheap stock for a while. When we first recommended it was quite cheap. But it's definitely a premium valuation for a premium company, though, right? Would you agree with that?
Yeah, and like on a forward PE basis, it's probably 39 times this year, but I mean 28 times next year's. But consistent, solid growth in earnings, cash flow, revenue, same location growth affords the company a higher multiple than you'd typically see. But it's still like on an EV basis or a cash flow basis, EV to EBITDA basis, it trades about in line with some of its acquisitive peers. So it's not like it's traded at astronomical levels or anything like that. If it had traded at what we would say silly levels at some point, we would have probably taken profit on it. But the street estimates right now and the target price right now is around $300. Now we think it's a little aggressive in the near term, but the company, I wouldn't bet against their 5-year plan looking 5 years out from now, as they've executed on about 3 5-year plans since we originally recommended purchasing it, and have recommended it about 30 times since then. So, I wouldn't bet against Boyd executing over the next 5 years. It's not going to go from 230 to $240 over the next, not that type of return, 11,000 plus percent. It's not going to do that, but it will likely beat the market, and that's what you're looking for in a stock.
And it's that clear and achievable growth plan that we talk about a lot, and that's what it has. Very clear laid out plan for growth and a track record of achieving it. So,
and then you gain more confidence that management can do it again, right? And and they certainly come through a difficult period. I mean, people stopped driving basically for 6 to 18 months, depending on who it was, on a relative scale. They just weren't out there. There weren't as many accidents. And the inflation that they've faced, the labor inflation, and to come out of that now and have 7 straight quarters of same location growth is, a testament to how well the business has been run, and where, we can expect, they're seeing a deceleration, but you're still looking at 6 to 12% same location growth. So that's organic growth. That's a good, for where they are in terms of the size of the business, that's a good growth level. And now they can start to add larger acquisitions. There are some struggling out there, multiple MSOs that have 7, 8, 20 locations that they can probably buy at a more opportune price, because those companies have been suffering through the same conditions that Boyd has. They don't have the buying power of Boyd. They don't have the the back end system that Boyd can come in and just cut costs when they move into a new location. So this is where they can likely go on offense again and accelerate some growth. All right, now we want to move to, so we can get through this week. I think we had Brett, and you are looking at, it starts with a P, Pivotree. I knew that. I know, I'm kidding. But I knew there was the 2 Ps, Pivotree and Pollard, and you want to look at Pivotree. I looked at them earlier in the year, but now we'll get your take on it with their recent quarterly numbers.
All right. So Pivotree, symbol PVT on the TSX Venture, is an end-to-end provider of e-commerce, supply chain, and master data management services to over 180 large and mid-cap retailers, branded manufacturers, wholesalers, and distributors in North America. The company supports clients on digital strategy, platform design and build, implementation, and hosting through to ongoing support. The shares are currently trading at $1.83, down 4% year to date, nearly the all-time low, which it was only set in late September in intraday trading. The market cap is currently at $49 million. Zooming out, however, looking at the stock since its IPO in late 2020, where it opened at just above $10, or I should say closed on its opening day at just above $10, moved up to $13.50 shortly after, and has since fallen in price almost continuously. Like many companies at the time, Pivotree really benefited from that euphoria in the market at the time, allowing for just lofty valuations based on revenue growth potential. And now we're really seeing the market come back to reality when it comes to these sorts of companies. But now we're in very different market conditions. So how has Pivotree really come down enough in price to have any value as an investment? So looking at its Q3 2023, total revenue decreased 14.4% to $21.1 million, or 16.5% on constant currency. Managed services, one of its 2 segments, increased by 9% to $11.2 million. However, what drove the decline was its professional services, which fell 31.2% to $9.9 million. The decline was really driven by the conclusion of projects and delays of additional projects. So effectively, they couldn't replace what was expiring with new projects. Additionally, annual recurring revenue fell 2.9% to $42.8 million as legacy Oracle projects fell off. Similarly, bookings for annual recurring revenue fell to only $0.1 million from $0.6 million, and total bookings fell 44.5% to $10.7 million, signaling just overall weaker market conditions. The company had a net loss of $1.8 million compared to a net loss of $3.6 million in the prior year. This is primarily because they were undergoing cost-saving measures in SG&A and R&D. Adjusted EBITDA also improved to a positive $0.6 million from a loss of $0.4 million. Shifting to the balance sheet, the company does have a great net cash position, including its leases of 9.1 million, but has been coming down almost continuously since its IPO. So we still need to watch that cash balance over time. The company does know it is pushing towards being cash flow positive, which it was positive during the last quarter when you aren't including its earnouts from acquisitions or its normal course issue or bid, which is just buying back shares. Meaning the actual operations of the company were cash flow positive for the quarter. However, once you include CapEx and end up in an adjusted free cash flow, they were still slightly negative, just a hair under break even of 75,000. So while the cash balance is really great, the cash flows are still just in a precarious position. We're not seeing that great leap forward like you want in these companies where they go from a large negative to a large positive effectively overnight. So using the company's adjusted EBITDA, which does exclude share compensation, which we've went over the pros and cons of it about a dozen times at this point, as well as it excludes its acquisition costs. It is trading at an EV/EBITDA of 14.2 times, so it's not exactly cheap to say the least. So, as well, we can look back using their price to sales as they've obviously not been even EBITDA positive since its IPO. We can see that after its first quarter as a public company, traded at nearly 3 times sales and has since fallen to under 0.5 sales. Clearly, it shows the shift in market mentality as the market is now valuing unprofitable stocks completely different than it was only a few years ago. So, our take. Pivotree came into the market extremely overvalued. While valuations have come down, it is still not exactly cheap. The company is still unable to be GAAP profitable and has signs of continued market weakness going forward. The company does have a good balance sheet and is nearing positive cash flow, but it isn't positive yet, and we'd obviously want to see at least a few quarters of that before really relying on it in any sense. The company's operations do have potential, but the company needs to be able to shift back into their top line growth, which they lost this quarter as they decreased, and as well they need to start to show a positive bottom line before we go any further.
Yeah, without revenue growth on the top line, and then you look down to the bottom line, it's either, on a cash flow basis, kind of breaking even, not enough to entice us to be looking at an investment in Pivotree at this point. We'd like to see growth on the top line and growth on the bottom line. There's not really much of a bottom line there. They have to prove they can consistently do that. So I think you laid that out quite simply. And at this point, despite getting multiple questions on this company over the last 3 to 4 or 2 to 3 years, we still continue to take a pass on it. And as you can see, the share price kind of says we've been right to pass on it over the past several years. All right, Brennan, you want to look at Pollard?
Yes, sir. Yeah, you didn't say last but least, but her last.
Well,
least.
I think they know the way we feel about it. So
yes, thank you.
Yeah, we spare you for 1 week, but you wanted to bring it back. So last and particularly least, Brennan.
Thank you.
With Pollard.
Pollard Banknote Ltd, PBL on the TSX, currently trading at a price of just over $30, has a $812 million market cap and a dividend yield of 0.5%. So Pollard serves the lottery, instant ticket, and charitable gaming markets, primarily in North America. And it is one of the largest printers of instant tickets in North America, with approximately 85% market share in Canada and 22% in the US. And the company also serves the US lottery market through its joint venture, Neo Pollard, of which it owns 50%. And in the last quarter, for Q3 of 2023, the product breakdown was about 76% lottery, about 14% charitable gaming, and about 10% e-gaming. Now, looking at the last quarter, again, Q3 of 2023, which was reported last week, I believe on November 7th, revenue was up 2.5% year over year to $128.7 million. And this growth was primarily due to an increase in charitable games, e-gaming, and higher average selling price of tickets, but was offset by a decline in lower instant ticket sales volumes, as the company noted that they're focusing its sales mix to avoid lower margin work. Now, adjusted EBITDA was up 21% to $24.8 million, and net income was up 7.7 or up to $7.7 million, or about 29 cents per share, compared to a loss for Q3 of last year. And the primary increase for both adjusted EBITDA and net income was an increase in equity income from its 50% joint venture of iLottery, which it grew its revenues from increased sales of Mega Millions and Powerball Jackpot. Looking at the balance sheet, it does remain healthy with no current cash balance right now, but a trailing net debt to EBITDA multiple of about 1.6 times. And just a note, the restricted cash is related to amounts held on behalf of iLottery customers. Looking at the valuation, right now the business trades with a trailing price to earnings multiple of about 26 times and an enterprise value to EBITDA multiple of about 11 times. And just for reference, that PE multiple remains slightly below its 10-year average of about 30 times earnings. So keep that in mind. Now, just looking here to conclude, I certainly think that Pollard Banknote is a good business, which has produced tremendous long-term growth with a revenue compound annual growth rate of 11% from 2013 to 2022. The stock trades with fair valuations given its dominant market share and track record, has a healthy balance sheet, and pays a slight dividend, which it has grown over the years. However, as management voiced in Q3, there was weakness in ticket sales volume, which was only offset by pricing increases, which essentially is not a sustainable source of growth over the long term. Now, looking forward to 2024, management noted that the repricing of instant ticket contracts will continue, which could potentially impact demand and hurt volume further as we see consumers tighten their wallets with increased interest rates. Now, overall, I think that the business will likely perform well over the long term, but seeing the potential near-term weakness in volume and potential difficult comparables to this year, I think the business trades, closer to fair value, at least in the near term.
Yeah, so you're saying just under 30 times earnings right now.
Yeah.
Grew revenue 2% in the last quarter. Definitely a really good business. Family-owned business, I believe.
Yeah.
Yeah, but it's we'd want to see better growth more consistently for that level of evaluation.
Yeah, like at least in the near term. And like that, this is the thing is, where are we going to see the economy go? Do we see people start to ease off on, lottery or gambling?
I'm not so sure they would. I mean,
Mhm.
lottery seems to be a very defensive industry. Now,
It's kind of sad how sticky it is in some respects.
Yeah,
it is. Yeah.
is sad,
I'm not worried about the defensive aspects of it. I would just,
Mhm.
in terms of growth, we
Yep.
just want to make sure that there's consistent growth. And then, with the dividend, it does pay that dividend, but 0.5%, it may as well not pay a dividend.
Yeah.
Yeah, and the iLottery part of it is attractive, and it's been growing, has it not, significantly? Yeah. So
Correct.
I mean, I believe it's quite profitable for them. So, it's a one that we continue to monitor for sure.
Yeah, good company. I mean, definitely, it seems like a solid business.
Certainly.
I like that it's unique in that I'm not aware of any other lotto ticket companies trading in Canada. So.
No. All right, well, that's going to end it off for this week. Keep your questions coming into our Your Stock, Our Take segment. If you want us to compare two companies, any companies within your portfolio you want a sober second look at, we can do that on the show. If you're watching this right now, viewing it on iTunes, smash that subscribe button right now, and we'll continue to provide great content on a weekly basis. If you're listening on iTunes, rate and review us. Only positive reviews. I know it's hard with Brennan here, but still, positive reviews would be great. And as always, again, you can get also those tickets. If you want to do the on-demand, you can still go to www.keystocks.com and get the on-demand webinar. As always, I wish you profitable investing. Thank you.
Thank you.
Thanks, everyone.
Thank you.